Good morning, YouTubers. Welcome to the Independent Investor for Sunday, April the 5th. Today I'm going to go through some technical analysis on why I think the market still is going to go lower. I developed a spreadsheet probably over the last 20 years or so that I've been adding indicators to it as I become aware of them and give you a sense of where the market is for us to be bearish or bullish. One reason I have a problem that you always hear reporters say on the TV that it's impossible to time the market, which to me is just a complete scapegoat for the financial industry. There is quite a few indicators I'll show you today, and you don't use one of them, but you use a combination of them, and you can get a pretty good sense of whether you should be buying, selling, or just staying on the sidelines. So this has worked for me in the past. It did give me a strong sell signal back in December 2007, before the financial crisis. Unfortunately, I decided to play the correction, took a bit of a gamble a different way, shifting money to Asia and things like that, which unfortunately didn't work out. But if I would have just went to cash, it would have been a successful play. So this spreadsheet now is down to, so I just take a percentage of each of the indicators, add them all up, and it gives me a number between 0 and 100. The dividing line is around 50, and one of the strongest buy signals I had was back in April 2009. So if I would, by using that, I was able to get back into this market right close to the beginning of the bull market. And then of course you just step in slowly at that point. Like I've said previously, once the market turns around, there's not really a big rush. If it's going to be a 3 or 4 or 5, in this case 10-year bull market, you can just slowly add to your positions over months, and even if it takes you 1 year to get fully back into the market. So, but the other side is the opposite. Markets fall very quickly, so I kind of use this indicator to start moving to safer assets. Actually, this gave me a sell signal 2 years ago, and I went back to cash, but I noticed the market continued to rally, and then I came to the conclusion that the market was basically rallying just because the Fed had continued to print more money. So like the old saying, don't fight the Fed. So then I started to watch the Fed closer. If they continued to print money, then I kind of stayed in the market, even though a lot of my indicators were saying not to be out. But what I did then was buy into more secure, high dividend paying companies, which I've mentioned about in numerous videos going back 1 or 2 years now. So when the market did fall, these companies would have a lower beta, meaning they would fall less than the market, plus they're paying a strong dividend. And they actually worked out quite well with some of the utilities that I've spoken about, especially in the renewable energy field, performing almost as well as the technology companies, because a lot of pension funds and that couldn't invest in bonds because bond yields were so low, went after these high dividend paying companies, especially the ones where the dividends were secure, like the renewable energies, like RNW, INE, for 2 examples, where they have 15, 20-year contracts, and their dividend payouts are secure. So and then right now my spreadsheet is at 44.19, so quite below 50. And that's still, even with the correction we've had to date, is still signaling a pretty good, strong sell signal. So today I'll go through just some of the things I have in that spreadsheet, mostly through charts, and I'll start off with what's called the death cross, and basically it's just moving averages. Most of you have probably heard of moving averages. If not, just Google the term, but it's just a way of smoothing out a chart, right? So there's less chatter, and it's easier to look at the trend and see the trend. 200-day moving average is very popular, and the 50-day moving average is very popular. And then what happened just not too long ago, last week, we had what they call a death cross. That is when the 50-day moving average crosses over the 200-day moving average. And you can see that right here. The red line is the 50-day moving average, and the blue line is a 200-day moving average. And we can see they just crossed. Now before you really want to buy again, you want to see this reverse. So you want to see the 50-day moving average come up and cross the 200-day moving average, and that gives a buy signal. But right now, we're not seeing any signal like that at all. We've just got the signal, so it's another reason I think the markets will continue to go down. And I can show you what happened. And this is a pretty early acting signal, meaning that if you use it, you're going to get out early and not lose too much, and you're going to get back in early. So you're going to be out for most of the bear, and you're going to get in for most of the bull. And it's worked for a long time. You've probably even heard the words mentioned in the press, death cross or whatever. So usually in economics or finance, things don't repeat themselves because the market becomes efficient and reacts before or after, in a quicker way, so it won't be repeatable. But for some strange reason, the ones that I'm showing you today typically have worked for 50, 60, 70 years, or since technical analysis really became popular with the advent of computer, because you need a lot of computer power just to create these, even to create a, you can do it yourself. I've done it just to create a moving average. It takes quite a bit of time. Do it by paper and pencil. It becomes quite arduous, but with Excel spreadsheets and everything else, a lot of these technical indicators can be done, almost instantaneously. So, but if we go back to 2009, so here's the crash. Basically, we've had a 50% correction. Went from 1560 on the S&P down to 720, or a little bit less, actually almost 680. So a good solid 50% correction. But you can see right here at the beginning, we had that death cross. So you can see if you would have sold here, you've been selling out around 1480, only about 100 from the peak. And then when it crossed back over, you would have got back in around 880, and then you would have had this whole run here that you would have stayed in. Because then what you kind of do, there is some chatter here sometimes in the beginning, but a lot of these technical tools, you kind of differentiate when to use them, and I ignore some at the beginning of a bull market and then pay more attention to them at the end. But one thing we can see is the 200-day moving average in the blue becomes this major support line. And you can see here, even though it's chattering here, you might have got a little bit scared. We had quite literally years here where it stayed above the 200-day moving average. So you would have said, this whole pace here, steady as it goes, just keep investing a little bit of money, market's good. We did have a dip 2014, and then we did have another dip around 2016. So it does give some sell signals, and even if you would have acted on these, got in, got back out, you still would have then rode this next wave where everything stayed above the 200-day moving average all the way till, which I talked about in December 2018, where the Fed started to take money off its balance sheet. They wanted, using the words normalization. As soon as they did this, interest rates went up to 3 or 4%, and from what you remember, in December 2019, the markets just started to crash. Fed realized economy can't support interest rates of 3 or 4%, started printing their money again, QE4 basically, and the markets then just basically turned around. So like I said, that's why I got back into the market, because I realized it's basically the Fed and their policies that are driving this market. And another thing has been the FANGs, right? Technology, your Facebooks, your Amazon, Netflix, that type of thing, and you might want to put Tesla in there or something, right? So, which is usual. Most bull markets have something that's driving it. Back in the 90s, 80s, we had technology like your Microsofts, your Dell computers. We've had ones driven by pharmaceutical companies, that type of thing. So we've had bull markets driven by commodities, where commodities can be quite strong. We had a bit of that when China was really starting to really increase its GDP every year and building lots of infrastructure. Those things like copper and steel, iron ore, that type of thing, had a good run. So it is good to try to define